Hello, welcome everyone. Thanks for attending. And my name is Seewing Yee, and today's Zoom will be a three-way conference call. My special guest is Maureen McCann from Spartan Invest, a leading turnkey real estate real estate provider company in Alabama, and they cover many areas in that region: Alabama, Tennessee, and northern Georgia. Welcome, Maureen.
Seewing, good to be here.
And Richard Advani from Supreme Lending, a nationwide leading mortgage lender in all 50 states. And Richard Advani is going to talk about what we can talk about today. Welcome. And today's theme is called the good, the bad, and the ugly of real estate. In case some of you may not go way back as I go, the good, the bad, and the ugly is one of the spaghetti western starring Clint Eastwood. Yes. So I'm gonna here's the format. I'm going to each of us will provide our definition, our perspective. What does it mean? So let me start off by my definition. It'll take 7 minutes or so about the good and the bad and the ugly of real estate investing. And then Maureen, you can go second, and you can go ahead and however you want to define it, your definition of good and bad and ugly with respect to real estate investing, and Richard will come third and last about it. So here's my take on it. The good aspect of real estate investing in today's environment, the good at is that everyone should know that real estate is local, regardless of the national headlines. There's no such thing as national real estate. It's all about the local market that you're investing. And the good thing is that our real estate market that we're promoting to our out-of-state real estate investors are still, for the most part, are still doing very well, meaning the prices are still stable. Of course, they have not gone up as much as in the past few years, but they have not, the prices have not gone down either. And in the market that we are presenting, of course, yours truly, Maureen, we're promoting Alabama area, and then Buffalo, New York, and Central Florida, and Southwest Florida, and Central Texas. Those areas, for the most part, have done very well. We have those areas still growing population and job growth, and those areas still cash flowing, not as much as before, but still cash flowing with 25% down payment barely. So the future is very, very bright in those affordable markets, and the reason why we go over those markets, we're promoting those markets. And the bad about it, the bad is that which is the interest rate, which is the mortgage interest rate for owner-occupied buyers. Of course, Richard will go over that much more deeply. Is around right now is around at least 7% for owner-occupied buyers, and investors, I suspect, could be 7.75% or even 8% interest rate. So that could affect real estate investing, and so that's a bad aspect of it. And as a result, we are seeing a slowdown in the real estate market all over everywhere. And so that could be a little bit concerning. That's a bad aspect. And the ugly aspect is that what if not only if the Federal Reserve maintains its 7% interest rate right now, or maybe go higher, from what I heard about the additional Fed meetings that will may make the mortgage interest rate higher than 7%. Now, not only that's going to affect real estate investing more so than currently. However, what if the recession could come about? Some say the recession is here already. Furthermore, what if the employment situation gets worse? There are some signals of a high-tech industry. They'll start laying off some people, so that's concerning. But however, if the job market are really are affected by it as well, then that's really going to be a very, very ugly. That could affect not only real estate, but it's going to affect the economy, the consumer spending, et cetera, et cetera. So that is my take. One more thing I think on the good aspect of it. The good part of it, let me finish up, is that we still have very, very low inventory nationwide. We are at less than 3% inventory, and there are some trends where the sales of housing sales are decreasing for the past few months, obviously because due to interest rate hike, and sellers are not selling; they are locked in the low interest rate, and buyers or the demand has subsided. So therefore, I believe the low inventory will persist throughout the rest of this year, the next remaining 2.5 months, into next year as well, 2023, or even further. So I believe the low inventory, it could be historic. Low inventory will be the saving grace for that will prevent a realistic crash, bubble, or whatever. So that is my final take: the good, the bad, and ugly. So with that in mind, Maureen, what is your take on what is your perspective on the good, the bad, and ugly?
I'll start with the good, right? So I've got a couple here. So I think the one good that I know is that there's a lot of uncertainty in the market, and investors are looking for something more certain. They're talking about volatility, they're talking about inflation, they're talking about interest rates. They're looking for a place to put their capital that is safe for them. And this comes really from a conversation that I had with a mentor of mine. He was in a room full of high net worth individuals, and he said the conversation was just asking there in private. The conversations were, where do I just get 5%? Where do I get 5%? Right? That's kind of what their standard was for right now because of all the uncertainty. So people are looking for certainty, and I do think that when you look at the history for centuries, real estate really has been one of the most, it's for me been the #1 wealth builder for families. And so when you look at rising inflation, housing values and rents tend to right alongside with it. I think it's going to be here for a little bit. So, if you're looking at an 8%, 8.3, whatever it is reported right now, you're looking at that is what your property will increase in value over the short run. There was also a report done by KCM, Keeping Current Matters, Dave Childers. He basically had the forecast from CoreLogic, HPS, Fannie, Freddie, Zelman. Zelman was the only one who said that predicted that there would be a depreciation in housing values, whereas all the other ones, they have project that it will increase over the next 12 months. And that is because of what you mentioned, Seewing, the undersupply that we have for housing. Yes, the demand is waning. It's not going away. It's just subsiding because of the higher interest rates. The other good that I want to say, and I believe this to be true, home ownership in the United States was at the peak 67%. Currently, it's at 65%. And Ken McElroy, who I was listening to recently, predicts that it's going to go below 60% for the first time in his lifetime and my lifetime. What does that mean for us as real estate investors? So if less people are able to purchase a home right now because of upward pressure on rates, or possibly concerned about job loss, then they're going to have to live somewhere. It's going to increase rentership. I'm not even sure if that's a word, but I'm making it up right now. You're going to see an uptick and increase in rentership just because the affordability is out of reach because of the upward pressure on interest rates. So I think that's a good thing for us as real estate investors, being the landlord offering that home that someone needs to live in with their family. Let's see the bad. The bad is I think there's just going to be a persistent, there's going to be persistent inflation, which means it's going to result in persistent and not significant, but I think additional increases from the federal fund rate, which will then affect the overall market, increasing the borrowing cost. So I think what a lot of investors are doing now, so that's the bad, but I think the you have to get creative in these kinds of situations. And a lot of investors are opting to put down 30 or 40% down, or they're doing debt coverage service ratio type of loans. So they're lending off of the asset. Actually, we've got I saw some good figures coming through from an investor. I just put in one of those types of loans last night. So we just have to get a little creative on that. So you can still position your capital in a hard asset that will cash flow, that will reduce your tax liability, that you'll capture the equity accrual and the capital appreciation. So it's still a good option in my mind. All right, so then the ugly. What could the ugly be here? I think that if the war in Ukraine continues to escalate, we're going to have a continued energy crisis. That pushes up prices for a lot of businesses, corporations. It's pushing us up for families already. So we're seeing some financial stress in just households. So I think we're seeing reduced spending and then timidity in making any type of investments at this time. I'm sure you've all heard, investors say, I just want to wait and see. I just want to wait and see. And I think that's kind of the sentiment at the moment. I think if unemployment rate goes up, which I anticipate that it will, because you think about it, the Fed, they have to reduce the spending. They just can't tell everybody, stop spending, because we're not going to do it, right? If you've got disposable capital, people are going to go out there in the market and spend. And so the way to reduce the spending is to increase the rates and increase the unemployment rate. So that's the good, the bad, the ugly on my take.
All right, Maureen, Richard, before you come on, I'm going to say one thing. Yes, I've been hearing a lot of my investors are also saying the same thing, that they want to wait and see attitude. They're not taking action right now. I believe that's a mistake, and Richard will elaborate on that. I'm sure you will. Richard, what I'm trying to say is, right? Yes, the cash flow is decreased for a few $100s, no big deal. But the investment property still good, still going cash flow, still have a long-term growth. The people that are waiting on our investors, they're waiting, any risk investors, they're waiting in the sideline on this current environment. They may be making a mistake because they try to time the market, right? And they're waiting for risk prices to crash or whatever before they jump in. So here's a problem: no one can time the market. And at least in our markets and Maureen's houses also, we're not expecting any kind of decreases in prices. So if our investors want to wait for the crash, it probably will not going to happen. They may want to buy in California right now. California have a decrease in price in about 7% right now. So they want to buy a $1 million house instead of 1.2 million. You can't cash flow on a house with that price ranges. So they're making a mistake. Not only that, investors, by waiting, they are foregoing asset value increase of the houses that they would have bought right now. They are foregoing the tenants going to pay down the mortgage debt for the owner, for the investor. They are potentially foregoing tax benefits they could have achieved. Some can receive substantial tax benefits with rental property ownership, and they're foregoing possible equity appreciation. So I still think, even investors, they need to overcome fear and buy right now and lock in the price, lock in the rate as high as it is. They can always refinance later to achieve better cash flow, but it's an emotional, bad, terrible mistake in my mind. So that's my take. So with that in mind, Richard, Advani, I'm sure you have some great things to say, the good, the bad, and the ugly. So I want you to emphasize the Federal Reserve, what they're trying to do. I know you don't have a crystal ball. You will be a mortgage broker. You understand about the interest rate. That's your job, really, Richard. So I want you to predict, if you can, about the next federal rate hikes, if it's going to affect the mortgage rate. Not only that, I want you to potentially talk about the forecasting about in next year, 2023. That's a next year, 2023, I believe, is a very important year, especially the first and second quarter of 2023. From what I heard, there's a lot of important things to talk about. So with that, and then Richard, the good, the bad, and ugly. Of course, go over the current interest environment, how it's hurting the primary homeowners, and how it's potentially hurting real estate investors with a higher interest rate, how they can overcome and go over the loan options that Maureen just went over a little bit. What several loan options that are turnkey mom and pop real estate investors can what kind of options they have in order to pull the trigger. So without further ado, go ahead and Richard. Sorry for this long introduction.
No problem. Yeah, so I'll jump right into the good, the bad, and the ugly. I'm actually going to use a news article I just read shortly before we jumped into this. And the reason why I'm doing that is all of us are out there seeing lots of media as it relates to what's going on with the housing market. And most of us as individuals will glance kind of the headlines and move on. And I think now more than ever, it's extremely important to actually look into these articles in a little deeper, because 99.9% of the time I read one of these headlines and I read the body and you realize how misleading it is. And, and this article itself is going to go over the good, the bad, and the ugly and address a lot of the things you were asking me to address. But, I was on Market Watch, and in bold, it says U.S. existing home sales fall again as housing downturn gathers steam, right? Super ominous. And sales decline, the smaller subtext, sales decline for the 8th straight month. And, so you're just like, oh my God, like what's going on in the real estate market? So, you read barely, a paragraph into it, and it says U.S. existing home sales fell 1.5%, right? And they're not saying the value. The amount of homes sold versus last year fell 1.5%. Now let that ring versus the article, the headline I just read, right? Nationally, existing home sales fall, and then you read the context. Okay, home sales fell, 1.5%. And then, a very interesting thing is, they talk about the percentage of first-time home buyers in that. So this just surprised me, 22% of all transactions were cash, right? Right away, that tells me the people with a lot of money, not just a small mom and pops investors, they're still buying, right? Because 22% of the sales, once again, were in cash. So there still is definitely opportunity out there. 26% of sales were first-time home buyers, up 1% from last year, right? And this is all the same article, right? So I'm going over the good, the bad, and the ugly all in this article. It's making it really easy for me. But what we're seeing is an overall trend is, people want in the media business and anything, you want to catch people's attention, and you want to do it with these headlines. And the more you read through these headlines, yes, look, interest rates have made a big impact on the market. The Fed basically says that the housing market's too strong and they want to try to slow the housing market. Now let's focus on that, right? Without artificial manipulation by the Fed, the housing market's too damn strong right now. That's the problem. Everything's going up too fast, rents and values, which has been great for all of us as investors, right? We love it. And we're not buying these properties for a year or 2 years. We're buying them long term. But if you look overall, and this article further references the chief economist for the National Association of Realtors. And look, at the end of the day, house values are being impacted a little, depending on where you read, as Maureen mentioned, you get different information. But even if you want to go with the big sticklers, right, like whitehouse.gov and Fannie Mae, they are looking at nationally a 1.7% decrease in home values, if you can believe whatever statistics, right? The bulk of the negatives are on the East Coast and the West Coast, California and New York. Most of anything in between is 1 to 2.5 up to 4%, depending on where you're actually investing. So, once again, as investors, are we investing for next year. I don't know any real estate investor I've ever worked with, unless they're doing a flip. But anyone doing a buy and hold real estate transaction that has an exit strategy of a year, right? Our exit strategies are way, way longer. And one thing I get asked very, very often is, oh, is there a bubble? Is there going to be a crash? And I'll leave it to the quote from the chief economist. He says, and another actually interesting thing earlier in the article is the amount of people selling homes right now has dropped dramatically, right? There's not a lot of inventory out there. And he basically says, look, at the end of the day, values can and probably will move down more slightly moving into the future. However, there will not be a housing market crash because of the lack of inventory, right? You need a difference between supply and demand, the most basic economic fundamentals, principle to really drive the housing market. And, right now we're in a situation, a unique situation. It's a situation that's not going to be rectified in the next decade, where we have an undersupply of homes. And that's what's caused the housing market to go nuts. And that's why now we're having an external factor, the Fed, that's slowing everything down because it's too hot. But guess what's not changing? That's driven the house prices and the housing market to go so crazy. The supply and demand, right? That's not changed, and that's not going to change. So, I personally am long real estate, and, look, we are kind of in a unique place right now to, there's not 50 people lined up to buy every house. There's maybe 3 or 4, but there's 3 or 4, there's a lot more than one. And the other interesting thing in the article is saying that on average across the country, houses sit on the market, and they're like, it's way worse than last year. Last year, houses sat on the market for 17 days. This year, even in this market where everyone's like, rates are too high and things are going down, houses sit on the market 17 days. So look, if you believe the narrative that house prices are going down and prices are dropping, houses are going to sit on the market a lot longer than 17 or 19 days if we are in a major issue with real estate, and if there's this major turn happening. So my opinion, obviously, in terms of rates are, look, rates are nuts right now, right? We're mid to high 7s for investors. We're over 7 for primary homes. The good news is it's still less than inflation, right? Inflation, the Fed's saying 8 or 9%. Baloney. Go out and buy groceries for 2 or 3 people and tell me it feels like 8 or 9%, or gas. So, the real number I feel like is closer to 12, 15, 18%, but even at the 8.5, 9%, right? Interest rates are still lower than the inflation rate. And then also on top of that is Seewing said in one of his webinars is, we're married to the property, but we're dating the interest rate. My hunch is rates may go up a little further, unfortunately, as the Fed probably will increase rates again. I don't think quite as sharply as they were originally anticipating. But once again, remember, the housing market is stupidly strong and robust. The external manipulation right now is the Fed with interest rates. Once inflation gets kind of under control, and once the housing market cools, which it's starting to cool, good job, Fed, congratulations. They are going to move rates back down. Now, are they going to go back down to the rates we were all spoiled with for a decade? 2.5% primary homes, 4%, high 3s rentals? Probably not. I don't see that coming. But are we going to get a happy medium, hopefully in the mid 5s for investors, maybe high 5s? I'm hopeful, and that would mean a 2% increase for a lot of us. So, in a year and a half from now, I foresee personally there's going to be a big refi boom for everyone who got all these, who continue to buy real estate in this market. But, for those people who are kind of on the fence, I understand it to a degree. There is volatility, but once again, the fundamentals of real estate haven't changed. They're going to continue to be there. There are opportunities right now in some markets, especially these new construction markets, where for the first time, hey, you can negotiate a little, but 3 months ago, there was no negotiations, right? They'll just hang up the phone on you. Now it's like, hey, can I get a little credit, or, can we do something to help my rate? And they're open to it. So, don't wait to buy real estate. As they always say, buy real estate, wait, be greedy when others are fearful, be fearful when others are greedy. And right now, if there's a lot of people putting the brakes on, I'm not saying just go be reckless, right? Analyze the investment, make sure it's going to meet your goals, but be real with what your goals are. You know, I still have people calling saying they want a 7% cash on cash return and you know, they want to spend 250. And I'm like, wow, that sounds great. You know, 7% is probably not realistic. But let me ask you this. If I can get you 7% return, let's calculate what that means. Okay, great. It's $180 a month, right? So what is this 7% going to do for you? You know, are you going to pay for dinner? Is it going to make you rich? You know, it's not going to make you rich. It may pay for dinner. And the, you know, investor ends up really, they're like, well, I'm not doing it for that $170. I'm doing it for the wealth creation of real estate. And, you know, and then, you know, you take a step back and you're like, what did you just say? Right. You're not doing it for this 7%. You're doing it for the wealth building aspect that real estate gives you. And, you know, even if property values, you know, I closed on something a month and a half ago, and if property values drop 5% or even 7% next year, I don't care. It doesn't make a difference to me. I'm not selling it next year. I bought it long term. And, you know, for those sitting on the fence, if you're sitting on the fence with, you know, I'll recap by saying this, but if you're sitting on the fence with, you know, money in a checking account, a savings account, or a CD, you're losing money. Like, don't sit on the fence and do that. I'd take a 1% cash on cash return with the long-term wealth building aspect of real estate versus having money, losing money in a checking account or a CD. So, you know, as much as we're chasing this front end cash flow, a lot of us are being silly and losing 20% of our cash sitting in the bank. So look at the whole picture. Don't just look at what's in front, look at what's here already and what it's doing for you. Yeah, thank you.
Well, Richard, great recap. As we conclude this webinar, what you said just really resonate with me, and investors out there need to hear what you just said. So, Maureen, I know you got to go very shortly. So, can you, for next remaining couple of minutes, can you recap what are your thoughts in light of what everybody just said, and then we'll end this webinar.
Yeah, thank you, Seewing. So, gosh, I love what Richard said and how he said it, because it is true, is that the fundamentals don't change. The fundamentals of investing in real estate don't change, right? You may have all these sensationalized headlines, you know, and then I think he made an excellent point about, here's the sensational headlines, your eyeballs go to it, you just skim it, maybe you don't dig down deep enough into the data to realize that it's not as horrific as the headline is making it to be. And, you know, the mind tends to want to believe the fearful. And so, you know, we kind of grasp onto that and then we pull back. But the fundamentals have not changed. And Seewing, both of you gentlemen spoke to this point, the undersupply is real. The number of people living in the United States that need and want a place to live, there is just not enough of it. And if you look at our southern border, there's just more people pouring in, right? So they need housing as well. We're already undersupplied. So everything, basic economics 101 is supply and demand. We're vastly undersupplied, have been for over, I think, 13, 14 years. Now we're trying to play catch up. We've got supply chain issues. You can't get the production out as fast as we need it to be. Builder sentiment for the 10th month in a row has declined because they want to be able to sell their product. And if they're concerned that they can't sell their product soon enough or fast enough, then they're going to slow their production, which only increases the wide housing gap that we already have. So you as a landlord or you as an investor buying now and holding till we get out of this thing, however you want to define what this thing is. But on the other side of this, you have got a portfolio of rental properties that are in demand and need, especially when home values or home ownership is going down, rentership is going up. Position yourself to be the landlord serving the community who needs a place to live. That's my final thought.
Very well said. And with that, thank you so much for attending. Richard Advani from Supreme Lending and Maureen McCann from Spartan Invest. My name is Seewing Yee. Thank you so much. Have a nice day. I will see you guys in the next video. Bye-bye.
Bye.